Welcome back, everyone. I'd like to welcome Phil Snape and Will Brown. And Will's the one, the good-looking one with the glasses. Sorry, Phil. I've known these guys since they worked on my campaign in 2018. But they do something really interesting that we thought would be interesting to all of you to understand kind of how new campaigns are being run, how we're getting better ideas of what people are thinking. And so they are from a company called Impact Social. And Impact Social has a unique approach to analyzing online conversations to create a massive virtual focus group. And so you don't have to go and ask questions. You just pay attention to what people care about. And so Will Brown is responsible for product development and client insight at Impact Social. He previously spent 5 years at Freud Communication, where he was the lead leadership team, responsible for developing and executing brand campaigns, social media insight, strategy, and activation. Phil Snape worked as a political speechwriter and advisor before founding his own lobbying company. Over the next 10 years, his campaigns became increasingly reliant on social listening technology. However, the algorithms used in the tech could not provide him with what he needed to understand, which was really human sentiment. And so he co-founded Impact Social with Will, and now they are pioneering a methodology aimed at providing unique insight to social media conversations. And today we've asked them to kind of take a look into what Americans are thinking about financial health in rural America. How are people feeling about where they are and where they may go in the future, taking a look at what they're saying today. And so I don't know which Will Brown's going to take the lead, but okay, Phil, you go ahead and take it away.
Lovely. Thank you very much indeed, Spencer. And hello to you all. Thank you for your time. So after that great introduction, we're Impact Social. We're going to dive straight into our methodology. Just to show you what we do and how we do it, and then we can go on and show you some analysis we've been doing with regards to the financial health of people across America and the difference between people living in rural areas and urban areas, which hopefully you'll find interesting. So quickly, just look at our methodology. So we start off, as you'll see on the left-hand side, what we do is we start off creating focus groups, giant focus groups. And so this could be a state, it could be a city, it could be a district, it could be the United States, it could be a region, an area. And then we try and create focus groups based within the area on the people which are interesting to the client. So it could be Republicans, Democrats, could be urban people, could be rural people, that sort of thing. Then when we've settled out, we're happy with what's going on there. We then write some code which is relevant to the client. So in this instance, we could write some code in relation to, say, people's savings and what people think about savings, or in relation to spending and inflation rates and that sort of thing. Then once we've written the code and the data comes into us, and this is from all the usual channels which you'll be more than aware of, you've got Twitter and Facebook and every single platform which will be out there. Once the information comes in, and this is only publicly available information, I should say, once it comes in, we clean it up. We might take the bots out, we might take all the stuff, if it's being gained by a political party or a campaign, we might take some of that out, because we're only really interested in what real people are thinking. And once it's cleaned up, what we do is, which is unique to us, is we randomize the entire data set and we pull it out and we read statistically relevant samples. So I'm talking about thousands of them from the perspective of the client. We put ourselves in the client's shoes and we read them. And the reason why we read them is because the algorithms which are currently used in social listening tools are very unsophisticated, and they can't screen for cynicism, they can't screen for sarcasm, they can't screen for context. So, for example, if my parent said something was sick, it means it's really bad. If my kid said something was sick, it means it's really good. Also, mood. It's really difficult to understand mood unless human beings are physically reading the data. And when it comes to financial health, of course, this is very, very important. How are people feeling? Are they feeling optimistic? Are they feeling pessimistic? What's going on there? Are they feeling nervous about the future, or are they feeling confident? This is very, very important to understand this. And it's also very important to understand the language which is being used. because, as you probably can tell from my accent, I'm from England, from London. We have a kind of London speak. There'll be a DC speak. There's a California speak. And so therefore it's important to understand the people, the way they speak, the people that you're most interested in. Ultimately, what we're trying to find is what people are thinking, what they're feeling, and why on the issues which are important to the client. And we can go back in time and look what people were thinking, and we can also then look in terms of what people are thinking now, and we can track things going forward, and we can see changes in people's behaviour and people's thought processes over time. There's a quick run through on the methodology, which you're happy to dive into later on if you want to ask some more questions.
So we want to show you an example from the Credit Union National Association. I'm sure it's familiar to a lot of you. They're one of our clients, and we did a big kind of pilot project with them last year in South Carolina, looking at this issue of financial wellness. And now we've kind of converted this year to a national piece of analysis. And we've just completed, or a couple of months ago, we completed a Q1 analysis for January through March this year, and when we're going to move on to Q2 pretty shortly in July, when we'll be rerunning this analysis, and we're going to track trends over time. So this is the snapshot from Q1. The way that we've done the national geographic picture is that we split the country into 5 regions, and this isn't perfect, but it's a reasonable approximation, and the client was happy with this kind of segmentation of the country into geographic regions. So we split into 5 regions. You can see there: Pacific, we've got the frontier in the middle there, Northeast, Midwest, the South, and that was a huge amount of work just to split the country into those kind of regions. But as well as the regions, we split between rural and urban demographics in those regions. So we can see what's the difference between the two different communities and the way they think and the way that they're kind of experiencing their financial health. So just a little bit to say about how we've done the geographies, and then the issues that we're looking at. The topics are between 4 key kind of pillars, or 4 index topics. We've got borrowing, job security, spending, and savings. And you can see there the kind of search terms that we're using, as Phil was referring to. This is the code that we put into the system, and then we code it around the geographies, and that information comes in. We physically read samples, and as you can imagine, there's a huge amount of reading to do. But then we end up with this kind of national picture. And just to show you what that looks like in terms of sentiment, we've got borrowing, job security, spending, and savings, as I was saying. And job security and spending are the ones that are really driving a lot of sentiment, and all of this is negative. So if you can see that everything on average is negative, it's not to say there's no good conversations, but net sentiment is negative across all these 4 issues. So you can see everything is below the line there. So you've got the maximum negative sentiment on spending in rural areas at 18.2% negative, but everything across the board in terms of net is negative. But what's interesting about this is that it gives a national picture to the client, and we can track that over time and see what the kind of national conversation is. But it doesn't really tell you the detail that we would want to get into. We're talking about rural communities. So what we're going to do is just explain what these topics are. So borrowing is, just to kind of give you the kind of top level. This is pretty complex. There's several 4 core themes that are driving it, and these are access to loans and procedural requirements, things like healthy credit scores or the ability to get a good credit score, the impact of interest rates on borrowing, debt, obviously, and student loans comes into this in a lot, but credit card debt as well, around borrowing issues, and institutional factors. So looking at what's happening with retail banking, turmoil in the banking sector. We've seen a lot of collapses recently, and obviously the role of credit unions, which is obviously the client. And what we're seeing in terms of borrowing, and one of the key takeouts is that American citizens are asking for, on a regular basis, guidance and tools from trusted institutions, and that word trusted is really important, if they're going to have positive outcomes in terms of their borrowing requirements. So Phil, you're going to talk about job security.
Yeah, so job security, so the overall picture of this is very mixed, as you can probably tell from the actual graphs there. It's obviously worse in rural than in urban. It's interesting in all of these different 4 areas. It's slightly worse in rural than it is in urban, but we'll go on to differences in the regions shortly. But the job security, it's very mixed. So some people are buoyed by the low unemployment rate, because this is the time when Biden came out and said this is the lowest unemployment rate for 20 years. which leaves a lot of people feeling positive about the future. People are feeling generally optimistic about the economy, and they read the economy in a positive way. And there's a small, where there's a small decrease in the price of eggs, for example, things say, oh, things are coming down, or they're saying that there's layoff containment and rapid re-employment of tech workers, so that the feelings are good and things are only going to get better. And this is completely counterbalanced by those who simply don't believe the unemployment figures and are convinced that they're being hoodwinked. They're pessimistic about the future. They see tech layoffs as inevitably spreading to other sectors. They feel strongly that accumulation of events, such as an increase in interest rates and rising prices, will lead to job losses and eventual recessions. And so, on the one side, overall positivity is created by the US unemployment rate is offset by this undertone of sort of real negativity from people who are thinking that only dark times ahead. It's very kind of schizophrenic in that way. And what I would say is that when we read all the data in all 5 sections across on this, is that where there is a good feeling, and I mentioned before that when you read the data, you get a sense of what the mood is. Where there is a good feeling, there's a sense of this as being very delicate, and it wouldn't take much to send it down. And so, therefore, even the people who are very positive, a lot of those people are quite tentative about their positivity. When it comes to spending, what's interesting about this is it was very, very close right across the board. Every single region across America is feeling exactly the same thing. People are feeling suffocated financially. This is an experience of like a sense that everything is going up, and there's very little respite. And for the majority of low-paid workers, particularly in rural areas, wages are not increased in line with inflation, and this left some people feeling poorer and in some cases unable to cope. There's a sense here, which is quite interesting, that some are having to take second jobs in order to make ends meet, which results in questioning the American way of life. And I think from a political perspective, if I was part of the government, etc., that would really concern me. Anger is being expressed at the price of goods, with eggs and chicken seen as the extreme examples, the kind of totem of this, of essential goods which have become ridiculously unaffordable. And also what's very interesting as well is the price of the utilities, the price of energy into homes. This is something which has been relatively stable over time and people could plan for, and it was a reliable cost. And now, because the cost has gone up the increase has been so big, then therefore there's a sense of incredulity and also anger about what's going on there. Who's to blame? Well, the government is taking a lot of blame for this, for not doing more to help people in need and keep the prices low. But also, big companies are taking taking a hit on this because they seem to be cashing in on shortages in the food chain and also the inflationary impact of global events. So it's kind of a mixture between government and big business, particularly the retailers and the manufacturers.
So just finally on savings, it's kind of a misnomer really, because the dominant conversation on that topic is mainly around people living paycheck to paycheck. There's a huge conversation. People are having to take kind of extra jobs, taking on extra hours, running out of money at the end of the month. It's pretty much the same both in urban and rural communities. We're seeing that as the kind of biggest conversation. This living paycheck to paycheck status, and a lot of that is eroded and undermined too by trust in banks. So people are saying, I haven't got any savings. The savings that I've got, I'm not sure that I trust the banking sector to kind of look after them. You've got the banking collapses, which is being driven by a kind of woke equals broke agenda from GOP and right-leaning individuals that I'm sure you guys would have seen a lot of. And really, this kind of savings position is very untenable. It's people aren't really talking about the fact that they've got savings. It's the fact that there's so many kind of barriers in the way for them to be able to save any money, because they're just kind of wage erosion and they're not earning enough, and the cost of living is going up, and the wages are too low, and inflation, all the rest of those kind of issues. So it's kind of like a misnomer to call it a savings, where people don't really feel that they've got the ability to save really any funds at all. But what we want to do for this session is just look a bit more closely at a couple of the regions. So we want to look at borrowing and we want to look at job security, but we want to look what happens, because this tells the national picture across the 5 regions, but we want to look actually when we look a bit closer between rural and urban communities in the sort of more specific geolocations, then we get a bit more of a different picture. So this is the issue of borrowing across the 5 different regions. So you can see we've got Frontier, Midwest, Northeast, Pacific and South here. And the biggest differentiation is between the frontier region and the Pacific region. So we thought, well, what's going on there? What's the topics of conversation that are different between rural and urban communities? So obviously rural is in the blue there. I hope you can see this, and urban's in the red. So let's just take a look at kind of deeper dive into those conversations. So looking at frontier first on borrowing. Here's the topics of conversation. So student loans, we've taken the purely ideological conversations out of this, which is around student loan relief and Biden's position on that and the kind of fight that's going on between right and left. We've taken that out of the conversation. As Phil said earlier, we kind of take the campaign stuff out. We're just looking at everyday conversations. And this is people talking about the impact of student loans on their personal lives. So it's not ideological, it's personal. And it's about, I can't afford a rent because I've got a student loan. I can't keep my credit score down. It's kind of lots of different issues that are related to student loans. But it's less of a big conversation point in rural communities than it is in urban, as you would probably expect. And then mortgage and loan rates. This is a really important one, and I'll come on to show you why, because it's really a bigger conversation in rural than it is in urban. So you can see mortgage and loan rates 19% there, and in for rural communities only 11% for urban. And this is fretful conversations around, I can't afford a rate, I can't switch my rate. People doing the math on the deals that they've already got in terms of existing agreements with financial institutions. And this is really kind of a nervous conversation around, I'm not going to be able to renew. What happens if my payments go up with interest rates? And it's kind of this really kind of worried, fretful conversation that we're seeing from rural communities, which is bigger than we're seeing in urban. Loan access, this is another key one, 16% there rural and only 6% in urban. This is not being able to find personal loan rates that are suitable to specific circumstances. And so whether this is small businesses, whether it's individuals who are self-employed, we see a lot of that in kind of conversation in rural areas. People have more than one job. They're going to the institutions like the banks, and they can't get through the kind of process to get a loan because they don't tick all the boxes. So this issue around loan access, even though their financial situation it should allow them to have access to financial support, they're seeing that there's all these barriers that are in the way. Credit unions, you can see there's quite a big difference, 10% to 3%. So we always see this in rural communities, people talking more about the credit unions, people advising their peers, people in their own communities to switch to a credit union. And that seems to be a kind of persistent conversation that we're seeing coming from rural folk, because obviously they can look at better rates, talking about the positive experiences they have with credit unions. They're not disappearing from the high street in the way that community banks and retail banks are. So there's some pretty key differences there in terms of the conversations between rural and urban, and that's in the frontier region. If we look at Pacific region, it's not as big a difference, but you've got things like bank services and fees at 16% rural and only 5% in urban. And this is down to local factors. So banks closing, as I was saying, this is people talking about not being able to speak to a human or an individual. The fact that they keep getting these fees lumped onto their kind of repayments, or they've missed a repayment and they're getting these kind of big fees. And it's more of an issue that's being discussed amongst rural communities. And then the other big difference is kind of credit score, 5% in the urban and the rural conversation to 2% in urban. This is really around a bewildering kind of set of rules around credit scores that change from institution to institution. People don't understand how to kind of navigate that. And this links back to the trust issue and the guidance issue that we're seeing all the time, that people want guidance and help to understand, why is it that as soon as I've paid off my credit card, my credit score goes down? And we're seeing all these kind of conversations with people saying, I've paid off my loan, but my credit score's gone down. How is that? Why does that work like that? And people need guidance and help to understand those kind of issues. And we're seeing that kind of more in rural areas than we are in urban. So I'll head over to job security, which is Phil. Again, we're seeing frontier and Pacific, just by coincidence, seeing the kind of biggest differentiation between rural conversations and urban.
Let me take you through the actual more detail of this in terms of the donut slides. And you can see what's really driving some rural topics is the general pessimism, which is being in a particular area. So you can see pessimism there, 23%, in rural, and it goes down to 14% in urban topics. And this is generally written, it goes on what I was saying before. People are worried about the tech layoffs, and you would obviously, but they're worried about them actually spreading across into other areas. And we've seen this in different parts of the country. People talking about the tech layoff here, because the tech layoff in the West, and therefore it spreads right across into different areas, as you might expect, and it's creating an awful lot of anxiety. They're talking about potential deflation, unemployment, increased interest rates, and things like that, and accumulation of which is going to drive them into recession. Interestingly, this is not necessarily driven by personal politics. There's personal politics in here for sure, but it's actually it's a belief that the economy has peaked, and it's only a matter of time before things worsen, impacting on jobs. You also have as well, of course, there's also a sort of negativity regarding the employment figures as well. They're much likely to be. I mean, this is quite political, but they're much less likely to be welcoming with regards to the employment figures. They're much less likely to applaud Biden and the Democrats for the achievement of the 50-year low job unemployment rate, and so therefore they're put off by that. What's also quite interesting as well, you see at the bottom there, job unemployment shortages at 5%, and then in urban it's at 1%. There's two bits to this. The first bit is personal jobs. What's the chances of me getting a job? So this is people saying, look, I'm well qualified. I'm very experienced, but there are no jobs around for my level of experience or education. And when there are, the jobs are often very, very oversubscribed. And then there's the other side of it where people are saying, I can't get people to work in my Taco Bell or on my farm or wherever else it might be. And so you see the differences between the two. And so that was very apparent when we read through this. Let's look now at the next area, and I'll speed through this because I know we want to have some questions at the end. In the Pacific region, and it changes. So you see layoffs are the big thing which is going on here in terms of job security. They're very concerned about it, as one might expect. But where the differences lie, people are a lot more negative about the employment rates in the rural areas. A lot more disbelieving about what the rates are, and they look around them and say, these figures are concocted by the government because they're not including the long-term unemployed. They're not including people who aren't looking for work, who haven't gone back after COVID. So they don't believe that at all. And also the personal unemployment rate is also a lot higher in rural as well. And again, there's two areas to this. Bear in mind, this is Pacific region. So you have people on the tech side who are very, very confident about being able to bounce back, and people are confident on their behalf of being able to bounce back. And then you have a group of other people who have been long-term unemployed, who seem to have missed the employment boom. And I'm sitting there thinking, what's there for me? What's left for me? Who feel like they've been pushed to the wayside. And that's obviously a big difference between people living in a rural area compared to urban areas as well. So we're just going to wrap up a bit now.
So just quickly on so quite often when we're showing analysis like this and insight, people are saying to us, well, how is the client using it? So I just want to quickly rattle through what that is. So the way they're using it is for communication, so message development. They're quite sophisticated in the way that they're doing the kind of digital outreach. So they're looking at rural communities versus urban, which is why we set up the analysis like that. And they're looking at the themes and the topics that we're bringing up, and a lot of the language that we're bringing up. So the reports that we send to them have got lots of verbatims and language in them, and they're using that to reflect the issues that they know those communities are talking about, and where they're, like we've just shown, on things like job security and borrowing, and they're reflecting those back to them in terms of their messaging, and obviously that has a bigger impact because it's showing empathy. Educating, so really helping CUNA's own members to understand the people they serve, and this is one of the key phrases that we always hear from the client, is that we want to meet people where they are, and that's really key to what credit unions are trying to do with their comms and their kind of advocacy efforts. They want to meet their customers where they are and have those conversations in a local area and a local community. Commercial issues, so looking at adapting things like their products and how they have kind of changed those to appeal to trends and needs. We've got the political piece, understand their political environment, and then obviously talking to lawmakers, big part of what CUNA does in their lobbying efforts, obviously in state and federal efforts, and so that they know what's going on in the communities that and constituencies of the lawmakers they're speaking to. And then over time, as I was saying at the beginning, this is the only Q1 analysis. Once we've completed a full year, we'll have some very kind of key trends in terms of attitudes towards financial health and wellness in the US nationally. And we believe that will become predictive and a kind of really important economic indicator.
But just finally on this, we spoke with Kuna before we spoke with you guys on this, and we talked about what the overall message is of this. And there are two things. What we're able to do with this analysis, and I think this is important for this particular group and everybody listening, and the One Country Project, is being able to meet people where they are, okay, where they are today. And the other important thing which came out of it was the desperate need for financial institutions or financial firms to be looked upon as being trustworthy. The big thing here is trust. Okay, so as we've explained, a lot of people here are feeling, they're feeling pessimistic. So they're thinking to themselves, well, who can I turn to if things go bad? Where can I go if things go bad? And who can I rely upon? And in these areas, what's happened is in retail banks, due to consolidation, are few and far between. And likewise, community banks are thinning out. There's a distrust of fintech, and access to online banking is limited due to access of rural broadband, which is obviously getting better, but nevertheless, it's not as it could be. And so there's a big need for financial support from people that they trust, people who know them, people who know their families, and people who know their needs. And this is why credit unions are so important, because they're filling that gap. And that was the big thing that came out of this. These people, if they're not in need now, they might be in need of the future, and they need people with financial know-how who can support them, who they trust.
Well, I'm going to jump in here because we're up against our keynote, but want to make a couple observations. The more data that you have that supports kind of a narrative, I think the more legitimate it is. And I was struck looking at this by how close this tracks the index of consumer sentiment, whether it's at Michigan or whether it's the one that the Fed does, that this is really kind of consistent. The other thing, as you were explaining it, is this sense that I don't believe the federal government's numbers. They say that unemployment is this. They say that they've created these jobs, but they're just not forthcoming with the real data. And the third thing that if we could just get some comment on, I was struck by how heavily student loans played in their thinking about credit. And now, as you may have been watching, the debt limit bill, the bill that extended the debt limit for the country, stopped or mandated that the president stop the moratorium on repayment. So it's going to be interesting, you guys, to see how those numbers jump up once people start having to, again, repay their federal loans. So you can comment on any or all of that before we have to exit here to get to the keynote.
Yeah, I mean, I think with student loans, we're seeing, everywhere we look at borrowing, it comes out as a massive topic. As I said, we kind of separated the ideology out of it. And taking the kind of pure kind of, well, this is an anti-pro-Biden stance, kind of, I believe in debt relief or I don't, or how come they're paying back kind of this cohort of students' loans when I had to repay mine. I've spent the last 20 years repaying it. We're kind of taking those conversations out. And what we're looking at is people still, in a spiral of kind of debt that they just can't see themselves getting out of it. And I think the message around relief is really difficult because it does spike those political, ideological conversations. I think they need to pivot towards helping people manage their repayments and helping people. Expectation might not be that you're going to repay it in 10 years, maybe you're going to repay it in 15, 20 years. But it's always spiking as a key conversation point. And everywhere we look at borrowing, student debt is always the number one topic of conversation within that issue.
I think just to add to that, I think the other thing which is very striking as well is that how much the student loans prohibit people from getting on in life. So they have this loan and then they can't get a car loan because they have the loan, or they can't get a mortgage because they have the loan. And what happens is people go, look, I was allowed to get 100 grand out from my college, but I'm not allowed to get 10 grand out from my car This makes no sense. There's this constant millstone. People took the debt out and went to college because they thought they were going to better themselves. Whereas in reality, the opposite has happened because of the fact they can't get ahead because of the debt is there, and and therefore it feels like it's never going to be repaid. And so it is something which I think inhibits rural America. I think it's something which stops people getting on, and I think as a consequence, people feel that they're kind of the walls kind of close in because there's nowhere to go.
Can you quickly comment on this idea that no matter what you say, look at record unemployment, you say people don't trust the government's numbers. And are you seeing that kind of consistently?
Yeah, and I mean, it's about, you're either positive or you're on one side or the other, and it's half and half. I think in terms of the figures, there's a general sense of, he says this, but there's several things people don't agree with. Firstly, they think that they're not including the people who didn't come back to work after COVID. They're not including people who are the long-term unemployed. And so as a consequence of that, they see people who they know have been unemployed for ages, and they are on benefits, but they say that they're not getting, because of the fact that maybe they're not taking the benefits now, or there's been a break or whatever, they're not being accounted in the figures. Or they're saying, I know, this guy over here, plenty of people who are sitting around now and they're 55 years old and they've had enough and they're not going back to work. So there's people around them who aren't working, and yet the figures are saying nearly everyone's employed. And so they can see things visually, and they know the reality. And it's not just like this is one town in whatever state. We're seeing this a lot across all the regions. They are seeing something and they're being told something else. And so you might say, yeah, but that's just a little poll, a little area. It's not. This conversation's happening, and we have literally been through millions of social media posts to get to this conclusion. This is a reality.
I also was struck by the fact that you're demonstrating or you're seeing financial insecurity because of job security. That goes against the narrative that there's so many jobs out there. People are job jumping on a regular basis. That we have no applicants for 20 jobs that we have. I mean, it is really interesting. I think when you look at these numbers, and I mean, I think we're going to have to jump, or otherwise I would have 100 other questions. But I'm really interested in how this looks in about 4 months when those student loan repayments come back into people's financial statements. I think it's going to be, if they feel insecure right now, they're going to feel even more insecure when they realize that the new federal law prohibited any kind of student debt relief as they were anticipating. So, yeah. Thank you guys.
We'll come back with the numbers.
We'll report back. Yeah.
I'll expect it. I'll expect a report back. You guys have a great evening there in London.
Yeah. Thank you. Thanks for having us.
You bet. Take care. So I'm going to hand this over to One Country board member, Secretary Mike Espy, to introduce our keynote speaker,